There is a palpable sense of anxiety sweeping across the trading floor as market volatility fractures investor confidence. In a single Thursday, the biggest technology companies in the world lost $890 billion in market value. This sell-off is driven by a sudden fear of capital expenditures, the heavy cash companies spend on infrastructure, currently being poured into artificial intelligence. But the data tells a different story. While market sentiment plunges, second quarter earnings growth across the S&P 500 has hit a staggering 43%. When corporate earnings surge this aggressively while stock prices tumble, it highlights a significant divergence between the market's emotional response and the sector's actual performance. To measure this gap, we look at the price-to-earnings, or PE ratio. This shows exactly how many dollars an investor pays to own $1 of a company's profit. Currently, the average S&P 500 company requires you to pay $21 for every $1 of earnings, despite having only moderate average growth. NVIDIA, however, is trading below that average. You only pay $20 for $1 of their profit. While the price is lower, the company's earnings are growing at 80%, completely dwarfing the broader index. Micron presents an even sharper contrast, trading at less than 10 times its earnings, while those earnings expand by 400%. The fundamental math indicates that these technology leaders are high-earning, premium assets currently trading at a significant discount. Achieving these growth numbers is difficult given current headwinds, like persistent inflation, and the rising cost of new trade tariffs. Yet S&P 500 companies have managed to hit a historical peak profit margin of 13.5%, the highest ever recorded in the United States. This massive AI spending acts as an immediate efficiency multiplier, allowing these massive operations to do far more with much less. Google's recent performance serves as a case study. They are spending billions more on infrastructure, but the resulting revenue is vastly outperforming those costs. The billions currently flowing into AI infrastructure are serving as the primary driver behind this historic peak in corporate profit margins. To understand the sell-off, we have to look past the individual stocks to the broader macroeconomic fears currently distracting Wall Street. Investors are worried that a strong labor market, with jobless claims at their lowest since 1969, will force the Federal Reserve to keep interest rates higher for longer to prevent the economy from overheating. There is also the fear that geopolitical conflict will push oil prices back toward record highs, potentially stalling the economic recovery. A look at the 5-year window between 2010 and 2015 provides some necessary perspective on how markets actually handle high energy costs. During that period, oil averaged $85 a barrel, yet inflation remained low at just 1.5%. Even with those sustained oil prices, the stock market rallied 83% over those 5 years. Current market volatility is largely a product of investor sentiment. The mathematical reality reveals a rare moment where some of the world's most profitable companies are trading at a deep discount.